eCash once that comes out. How about you?
Yeah, man, we're just getting forked left and right here.
Welcome to the eCash Beat with Shaun and Jeff. I'm your host, Shaun. This is my co-host, Jeff, and we're going to dig into a little bit about that fork coming up in August, but there's quite a few things going on in Bitcoin over the last week that we're going to jump into. Jeff, are you ready to start talking about some of those topics today?
Yeah, let's do it, Shaun.
I did want to start with, I love your updates on the gold and Bitcoin ratio, and you did make a post here on this. Let's dig into that a little bit here. What's happening with Bitcoin in relation to gold?
Yeah, so as you know, this is something that we've been tracking since February 28th. And basically, the reason why we started on that date is because that's the date when kinetic warfare, missiles, bombs, explosions started between Iran and the Western countries like US and Great Britain. So we thought, well, since gold is usually a risk-off asset, it should outperform Bitcoin. But what we found is that it has not since that date.
And it looks like, we used to be at 30%, a 30-point difference, and now it is narrowing a little bit. It's down to 23, right?
Yeah, this recent pullback in Bitcoin has narrowed the spread to 23 points in favor of Bitcoin. But, regardless of the actual price, how we're measuring this is that both assets start at the same value on day one. We are indexing this chart to 100. So we're starting at 0 for those assets 100 for those assets on February 28th. And we can see that Bitcoin at 108 is still outperforming gold.
Yeah, I noticed that on your chart now that we got a little bit of data here for a few weeks, how there was a little bit of a pullback, but it's still massively outperforming it, which is, like you said, in the past, not something we would normally see. Well, I'll be interested to continue following that. That's kind of interesting. I wonder how much of that is related to some panic in the markets. There's this talk all over X right now about Michael Saylor selling Bitcoin. And I like this kind of thought by Trey Sellers, actually. He posted this, and he's like, basically talking about, the cost of Bitcoin, when you talk about the percentage, is just massively an insignificant part of their portfolio. And he says, I sold much higher percentage of my stack buying Steak and Shake this past weekend than Saylor's performative selling. And he's referencing the fact that Saylor, when he sold 32 Bitcoin, that's 0.004% of their entire holdings. And it's just really insignificant. Now, here's the key for me. Like, the internet just went crazy over the last few weeks when they said they might sell Bitcoin. And they backed up the reason why they'd sell Bitcoin, especially when it's at a higher cost basis. And they'd still be a net buyer. But now that he sold some, it's like the world's about to end. Like, this is over. Like the Peter Schiffs of the world is, aha, I told you, he got rid of 32 Bitcoin. Told you guys it was going to 0. What's your thoughts on Saylor finally selling some Bitcoin?
Yeah, there's a lot of speculation all over the place. But if you actually look at the filing from this sale, the proceeds are going to expected to be used for fund distribution. So these are going to, this is what Saylor calls inoculation. They are inoculating this idea. They are injecting it into the market. And I think they're doing this to build confidence in their preferred shares. Because investors are a little concerned whether or not they'll be able to follow through on those dividends. We're not concerned. I don't think that's a big risk. I think they'll continue to deliver on those. But Saylor is simply inoculating the market right now.
Yeah, it definitely seems to be a nothing burger. He preps everybody for what they're about to do when the timing's right, and the timing's right, and it's such a small amount, but couldn't pass up touching on that. Next week, I'll probably dig into a little bit about their March to 1 million Bitcoin. Not a lot's changed there, but it seems like they're still on track for hitting that this year. If we could transition, Jeff, you had a post here about Saylor, and he had some interesting quotes in this interview that just dropped. I think it was in the last week or so. Tell our viewers kind of what some of the important takeaways from this discussion was.
Yeah, I love this clip. This is pure Saylor maximalism. He's in full philosopher mode right here. And my favorite thing that he says here is everything that you own in the physical world, you own at the pleasure of someone more powerful than you. And I just find that statement reassuring from our standpoint, in the sense that as Bitcoiners, we are protecting our valuable property in cyberspace, which makes it incredibly hard for someone to confiscate, at least when you're using, public-private cryptography and holding your own keys.
So now you talk to a lot of traditional type investors, at least I mean with the fund you run. Is this a common issue that you run into? Do you hear this still from a lot of people? This is something like you and I know that this inability to touch Bitcoin doesn't matter. In fact, it's a benefit. It's not a problem. But do you still get a lot of that narrative from people that invest in like your type of fund?
Yeah, absolutely. One of the big pushbacks I get from investors is that Bitcoin just isn't tangible, right? I can't feel it. I can't smell it. I can't, interact with it, I guess. Although if you are somewhat technologically savvy, you can do that. But it is a common argument that I get from people not wanting to own intangible digital assets. However, Saylor flips the narrative on its script right here, and he highlights one of the most extreme benefits of having property stored in cyberspace, which is you can literally take your Bitcoin to your grave. This literally allows you to decide who is in control of your property. To his point, everything in the physical world you own at the pleasure of someone else, someone more powerful than you. And this clip really is the sovereign individual thesis in real time using public-private key cryptography on a decentralized ledger. Right? This is going to define the next century of what investing looks like. People are going to start considering more putting their property into cyberspace because of the fact that everything else you own at the pleasure of someone more powerful than you.
The risk is there that somebody could always get that from you. Interesting.
Right. And it's a low, like, I'm not trying to exaggerate that risk too much, because some people are like, Jeff, that's really extreme. Why would you even say that? That would be the end of the world type of scenario. And I would just highlight, well, it actually probably is what's going to define the next century of investing. As counterparty risk goes up, as chain of custody is really obscured and uncertain, you want to be able to verify and know you are in control of the assets that you own to some degree. I don't think that custodial solutions are going to go away entirely. In fact, part of the reason why we have a fund is to help people with that. But it also highlights a new revolutionary aspect of investing that we've never had available to us before.
Pretty profound stuff. And yeah, Saylor always has an interesting way to be able to break that down. And I had finished most of that interview. I have about, I think, 15 minutes left on it. So definitely recommend that for the viewers if they're interested. Who isn't interested in hearing Saylor talk about Bitcoin, right? Speaking of big news, we're on the eCash beat. We're Bitcoiners, so obviously we're not big fans of the eCash. My understanding is there's a specific block that this Paul Stork method, this hard fork is going to come, and it's going to be in August. So we don't know the exact date, but we know roughly it's going to be in August. What are the key takeaways for those of our viewers that don't know anything about this eCash split? What's going on? What's the purpose? What's happening with this?
Yeah, basically a block height 964,000. I believe that's the block height number, which is estimated to occur in August this year, late August. Everybody who owns any Satoshis is going to get an equal amount of eCash, I believe, in their wallet, right? That same wallet address. I've actually never received any hard fork coins before. I got into Bitcoin in 2018. I think the Bitcoin Cash hard fork happened in 2017. So I didn't experience that for myself, but this will be interesting because I'll open up my wallet essentially, and I'll be able to have access to this new fork of Bitcoin called eCash. So yeah, there is some history there we can kind of briefly get into if you think it'd be worth it for our viewers.
Yeah, I think so a little bit. It's interesting. I mean, I remember vaguely the 2017 split. I wouldn't call myself all in Bitcoin at that time, so I didn't quite understand it all that well. It was more just number go up type thing I was concerned about. But I'm looking at some of the details here. There's some pros and cons to everything as far as why they're trying to change things. I'm not sure how much of this will actually be adopted. One of the things that I don't see talked about too much is it was going to reallocate some old what people are considering abandoned Bitcoins, Satoshi's coins. So they're assuming that these coins will never move, they're not able to be accessed, and that they're going to start with this new sidechain or this new fork of Bitcoin, and it's going to reassign those to other developers. Do you know much about that concept or what he's claiming there?
Yeah, so any coins I think that were associated with this Pintoshi pattern, which were the wallets that Satoshi had, which the Bitcoin hasn't moved since those wallets were established. Those Bitcoin, which I believe was like 1.1 million BTC in the Pintoshi pattern, those are going to be distributed to I think accredited investors, developers, venture capital investors, insiders. That's his plan.
Seems like part of that's trying to fix something that isn't a problem. It doesn't need to be a problem to be fixed. I guess it probably, correct me if I'm wrong, this is more of a layman's kind of opinion on this. It won't matter if the chain doesn't take off. If nobody transacts on it, nobody buys it, people dump it, and it ends up being like another failed fork, I guess it doesn't really matter who they assign those coins to then, right?
Yeah, and I think he has an uphill battle here, or they do. They try to find product market fit. You got to ask yourself, do drive chains and side chains have product market fit? And going back into the history of this, Paul Stork, who is a longtime Bitcoiner and developer, originally introduced two BIPs, two Bitcoin improvement proposals. One was BIP 300 and the other one was BIP 301. 300, I think, was introduced in 2017. 301 was introduced later in 2019. And they just didn't get any traction, right? They weren't adopted on the consensus layer. They were proposed as consensus layer changes, but they also didn't affect the underlying base protocol. These were designed as a layer 2 in order to try and help scale Bitcoin. I actually thought it was a very interesting proposal, but the community as a whole did not adopt it. So it sounds like he just got tired of waiting for the Bitcoin consensus layer to approve these changes and decided to hard fork it, which I don't really blame him. I mean, it's kind of apparent that these changes were never going to be made in Bitcoin, so he's going with the fork.
So if you really believe in your suggestion, you start this fork chain and see if it's successful. I guess, yeah, it's a good way to put it. I mean, I've heard of Paul Stork. I don't know a ton about him. Seems like he's considered as somebody who's really driven the conversation a lot, but as far as in actual practice, what kind of changes he's done, doesn't seem like it's actually doing much.
Yeah, and I think one of the bigger takeaways too for Bitcoiners is just that this isn't going to affect us, right? The Bitcoin that we have is the Bitcoin that we have. It doesn't change anything. It just gives you something actually, and you can decide whether or not you want to sell it or hold it. I don't know what the tax implications of that will be, but you might want to look into that. Shaun, what do you think you'll do?
Well, I'll be watching the day it happens to see what the value is, and as quickly as possible, probably dump it for what little fiat I can convert back into Bitcoin. So I probably will contribute to its demise, is my guess.
Do you remember what happened to Bitcoin Cash after the fork?
Not specifically exactly, because like I said, I was more into number go up stuff, and I had some other junk. What do you remember happening immediately after the fork?
Yeah, since I wasn't involved, I don't really remember, but I did a little research, and I think what happened was Bitcoin Cash, at least initially for a short period of time, I don't know how long, it went up a lot. Like Bitcoin Cash went up and Bitcoin wasn't going up. And so that was, I think, really shocking for some people. And then eventually just crashed back down to where it's at today, which is basically zero. I mean, the crash happened pretty quick. It went up, it was a pump and dump, went up, went back down, and then continued to underperform Bitcoin really soon after that fork, I believe.
So basically, it sounds like it was just like a pump fund on Solana where it was easily rugged, except you might have gotten lucky if you're one of 100 people, huh?
Right. And I think it just goes again to show the hardened consensus mechanism and the balance of powers that Bitcoin has, right? The proposal fell short because there was no activation path that was never clearly defined. Drive chains were viewed by many Bitcoiners as a potential risk and a potential attack vector. So there was really never broad signaling for BIP 300 and BIP 301 to move forward with it, which is, I think, what's leading to this hard fork.
Yeah, sounds like it's his path to finally test it in the wild and see how it works. Well, I mean, that's one way. That's a free market. You'll be able to see if it was something that was worthwhile or not. Huh?
Mm,
Well,
true that.
I really am interested in your opinion on some interesting fireworks that happened over the last week too, and it's with Jamie Dimon, and we know he's kind of been on again, off again. He's historically disliked Bitcoin and all the threats to his system. I'll mention just one quick thing, and then we'll get into some of the important parts of what this matters. But there was a moment here where the interviewer was asking him some questions, and he basically says, without naming Brian Armstrong, when he says he's representing the industry and why he's fighting for the people, and he just instantly says, yeah, he's full of shit. And she's like, well, that was an interesting moment. And my takeaway from that is he's a professional CEO, businessman of a massive banking company. And this interview, he looked unstable. He looked unhinged. And it makes sense from one angle. He's being attacked by an industry that's going to basically ruin his entire industry. What were your takeaways on the interview, but the actual key points of it?
It's funny to watch this story evolve. And ever since I discovered Bitcoin, I knew that the bank's business model was in jeopardy because we essentially are our own banks when you self-custody Bitcoin. But now we have stable coins, and now we have the Clarity Act, and now we have the Genius Act. And let's think about what the bank's product actually is for a second. The product that a bank has is just the balance sheet they own, the customer's deposits. Your money that you put into the bank is their product. And with this, they control payment rails, they control movement, they earn a spread on the deposits. They own the legal plumbing through which most dollar activity has historically moved. But now stablecoins are breaking that monopoly at the margin.
It's interesting. He had a comment to that point in this interview where he wants stable coins to play by the same system that they are for protections for the consumer. Yet they gloss over the fact of the risks with the banks on how with fractional reserving, how they don't actually hold the money. And stable coins are actually a safer option and vehicle for investors and people that just want to park their money. Yet he's basically gaslighting the industry by making it seem like it's still more riskier.
Yeah, totally. If stable coins continue to scale the way they have been, and I don't even think we've seen the beginning of this yet. The bank's deposits, remember, their product is your money. Their deposits become more contestable with stable coins. Bank funding gets less automatic. And if bank funding gets less automatic, the old spread machine weakens. And when that happens, banks either have to compete harder, pay more, integrate stablecoins themselves, and lobby to keep, their competitive moat. Ultimately, I think this all leads to Bitcoin. And it has a lot to do with the fact that we have left a sound hard money standard, why this is happening. So in my mind, the Clarity Act matters a lot. It matters because it starts converting crypto from speculation to a more regulated vehicle, and the banks see that happening and they don't like it.
Yeah. Thinking about the risk, we have a few minutes to dig into this without getting too far into the weeds. We had a conversation about this over the weekend a little bit. Maybe you can help our viewer break it down, myself too, a little bit more. Back in 2023, there was a big issue that was pretty apparent in some unrealized losses that they had on the balance sheets, the banks with bonds. It had to do a lot with rates climbing. Would you break that down like you did to me just briefly as far as what that means for the banks, what the risks are when it comes to these bonds?
Yeah, it goes back to the spread that banks earn on customer deposits. And part of that spread is their investments in treasury bonds, long duration treasury bonds, 10-year bonds, 30-year bonds. Now, what we've seen happen over the course of time is that demand from other sovereign nations like China, for example, and even Japan, right? Demand for those treasury bonds has gone down. And who's coming in to fill the gap? Stablecoin issuers. Tether, I believe, now is the 17th largest holder of government debt, treasury bonds, long duration bonds. But the problem is very much highlighted in this post by Balaji, and it goes back to the end of 2022 and 2023. One of the most very telling signals here was the Fed, their forecast. They published their rate forecast. And what they forecast back in December of 2020 for their rates, their 2023 rate amount was 1%, right? The Fed said in 2023, interest rates is going to be at 1%. So what did banks do? They loaded up on treasury bonds.
Sure. Yeah.
What actually happened? Rates went up their fastest clip in history. In that same year, they went up to like what 4.75%.
Pretty
So what did
quickly
that
too,
do?
right?
Yeah, very quickly. So what did that do to the bank's balance sheets? It jacked them all up in a bad way. And all of a sudden they're sitting on $600 billion in unrealized losses. Uh-oh. Well,
Man.
what we saw that has happened every time before is the Federal Reserve comes in to save the day, basically by creating this backstop facility called the BTFP, which basically allowed eligible banks, credit unions, and other depository institutions to borrow up to 1-year term loans from the Fed by pledging U.S. Treasuries as debt, agency debt, and mortgage-backed securities as collateral, valued at par, valued at face value. So they basically said, oh, you know what? Forget those unrealized losses. We'll create a facility for you to backstop those losses so that you can lend to us and borrow from us. It's so funny too. During that time in 2023, in March 2023, the FDIC chairman, Martin J. Grunberg was his name, he came out with a statement and he said, the current interest rate environment has had a dramatic effects on the profitability and risk profile of banks, funding, and investment strategies. To me, this goes way beyond the banks fighting stablecoins. They're fighting stablecoins because they don't want their deposits to flee into these new dollar-backed assets, crypto assets that are pegged one-to-one. The bigger problem is this is what happens when you don't have a programmable supply schedule like Bitcoin has. We know exactly how many Bitcoin is going to be created all the way into the very last block, which is estimated to be in the year 2140. We know. It allows us to predict the inflation rate rather than trust the authorities who say, oh, yeah, interest rates are going to stay at 1%. That's why nobody wants long-term government debt. That's why the fight for stablecoins matters, because the banking industry is getting squeezed. Nobody wants long-term government debt. There's now another issuer that is issuing a dollar-backed stablecoin, and the government loves that because it perpetuates dollar hegemony. It allows other countries to adopt dollars easier than in the legacy traditional banking system.
This is a very interesting topic, and I know we can get pretty technical and in weeds on this. I think that might be something we could dig into on another episode sometime, because it's something that is not going to end, and the banks are going to continue fighting because they have to. If they don't, they're done. So maybe we think about covering that on a future episode. There's a lot of things happening in Bitcoin, and a lot of times when we get to these ranges where Bitcoin price is kind of the same over a course of a few months, people get bored. They look for other interesting things. But right now, there's a lot of things happening in Bitcoin, and just a handful of them we touched on our episode here today. I think this is a great time to be paying attention. How about you?
Absolutely. Everyone is so pessimistic right now. That's the signal. Like when sentiment is high, maybe you get worried. When sentiment is this low, you stack harder.
Right. Well, I think this is a good spot to wrap up today's Bitcoin beat, and we'll cancel our plans to swap over to being the eCash beat. I think you and I are both in agreement on that, but we'll watch that. We'll watch some of the other things that are happening with some other soft forks happening, other things in the industry. Next week, I'll break down a little bit more about Strategy Stack, and we'll get an update on when they're going to hit 1 million Bitcoin. We have some interesting conferences coming up. There's a lot going on in the space, so definitely some stuff to cover and check out. If there's topics you want to see covered as the viewer on our show, we're open. Send us a message. We got all our links listed below where you can reach out to us. Any last comments for our viewer before we sign off this week, Jeff?
I just would reiterate what Saylor said in that video clip you shared. Everything you own in the physical world, you own at the pleasure of someone more powerful than you.
It's powerful. Yeah. All right. Well, then I'll sign off. Let you guys know, as always, if you don't have any Bitcoin, just get off of zero. But if you do have some Bitcoin, keep stacking sats. Thanks for joining us. We'll see you again next week. Like and subscribe. Check out our X channel, and we'll see you again.
Bye.